Okay, let's get underway. Welcome everybody. We are still getting some people through the door, but I will start because we promised we'd start at 6:30. We've got about 90 minutes of this, so we've got a lot coming at you in the next 90 minutes. Welcome to this IG event. I'm Jeremy Naylor. The title of this event, as you can see here on the screen, is Oil: Has the Market Changed Forever? Now, this year was meant to be a year of big celebrations for OPEC as it marks its 60th anniversary. But what's its future? How has the rising importance of non-OPEC nations changed things? What do the recent developments in the market mean for companies in the oil and gas space? And returning to that question again, oil: has the market changed forever? And of course, if the answer to that is yes, then clearly OPEC has to change with it. We'll endeavour to answer all these questions over the next 90 minutes or so with our panel of guests, which we have lined up for you for this evening. But first, a few points. This evening is split into several segments. First up this evening, we'll talk about the oil market itself. We'll be with Malcolm Graham-Wood, who'll be joining us online in just a moment's time. He's from malkiesblog.com. We'll get some more detail about Malcolm's background in just a couple of minutes' time. Then we'll look at the current situation from the view of a specialist in the upstream oil and gas business and how it feels to be a chief executive of a small cap producer. That's Roy Kelly from Victoria Oil and Gas and Hurricane Energy non-exec director. Third, we'll look at how to trade the current markets and also look at an area that has only recently come back into view. That's the business of making money in oil storage. That's with my colleague Josh Mahoney, technical analyst. And last but certainly not least, and in fact to some of us this is perhaps possibly the most important thing, the actual way you trade these markets and the mechanics behind this. We'll take a look at the way in which we present the markets on our platform, and we'll take a look at the risks of seeing a market that you may be in turning negative. And of course, we all had the experience of that over the last few weeks. So we'll look at that in some more detail as well in the next hour or so, followed by questions. The presentation will last, or the four presentations we have for you will last between 40 and 50 minutes, perhaps maybe a little bit more. And then we'll have a brief roundtable discussion, bringing some of the threads together. Then we'll take written questions from you, the guests for this event. You'll see from the drop-down menu on the right of your screen, hopefully, where you can pitch in with a question. Well, you're more than welcome to put a question in during the presentations. We will not be going to the Q&As, questions until after our roundtable. So you may like to make a note of any questions you might have and then send them across during the discussion. The session is being recorded, so if for whatever reason you have an interruption to your broadband or there's an issue, you will be able to pick up the full recording, perhaps possibly tomorrow or the day after, perhaps we'll get it to you at least within 2 days' time, and you can then listen to the entirety that way. Any handouts for the presentation will be available to be downloaded from the drop-down menu. We've got one there at the moment, but we'll send another one on to you tomorrow, which is the presentation given by Roy Kelly a little bit later on. So now, before we go to our first guest, I wanted to take a view of what you think the markets are going to be doing. What we've got here is a couple of polls that I quite like you to take part in. This is the first one. I'm hoping you can see this. We're distributing this poll the first of the evening. We've got 3 in total tonight. The question is, have we seen the lows for Brent crude this year? I'll wait until we've got around about 60 or 70% of the people having voted to get a really good idea as to what we've got to the answer to this question, because clearly as traders, we want to know where this is going. And we've got almost all voted. If you can, a couple more seconds and I'll collect those together. So let's take a look at what we've got, and if I can publish this, let's see if we can get this published. Right, let's close the poll and share the results. So we've got 73% say yes, we have seen the lows for the year. 27 no, we have not seen the lows for the year. So that's the first of the 2 polls that I want to run in this part of the evening. The second poll, which relates to this poll that we've just had is, where will Brent crude end 2020? Now, will Brent crude end 2020 lower than $30, between $30 and $50, or higher than $50? We're looking for the end of 2020, so we're talking 7 months or so to the end of the year, just to give us an idea as to how you are thinking about where things are going between now and the end of the year. And of course, before then, we have the full celebrations of the OPEC 60-year anniversary. That's formally coming mid-September. But as I said earlier on, it may not be the celebration that OPEC wanted. Right, we're 80% up. Let's take a look at the results of that and share that poll as well with you. Lower than $30, 14%, 76 between 30 and 50, and 12% higher than $50. So that's an interesting spread. And we'll hide that now, and I'll go into, let's see if we can hide that poll. There we go. Right, I'm back, and you'll see here the disclaimer that we have to run. That those that go to these events regularly will be familiar with that disclaimer. Now, armed with what you think, let's go to our first guest, Malcolm Graham Wood, founder and managing director at Hydrocarbon Capital, and also the author of the much followed malkiesblog.com, a daily column from the oil markets, and he publishes along with that the bucket list, which many of you will be familiar with, which is a list of small cap stocks in the oil and gas business. IGTV has interviewed Malky on a number of occasions. I'm sure you will have seen those interviews pass on your platform. But let's bring Malcolm in now with his presentation for the evening. Malky, it's great to talk to you. Thanks indeed for joining us on this Tuesday evening. Let's hear your presentation.
Much for inviting me to say a few words today, Jeremy, and unusually not in your studio. You very kindly given me an easy question for a few words. What is going on in the oil market at present? It's probably easier to say what is not going on in the oil market at present. I'm going to, first of all, I'm assuming a great deal of knowledge from the people who are on the call with us. So any stage, feel free to ask questions, Jeremy said. I'm going to divide my comments slightly unusually into a number of key parameters, which have made this a particularly tricky only 3 months, and what is without doubt the perfect storm in the oil markets. The first one is the speed at which this has all happened. As we look at how 2020 has panned out, it's important to show just how the major international activity has happened so quickly. With from Wuhan to the West Coast and Texas, the pandemic has left few undamaged one way or the other. And what started as a health scare is what we're talking about in international demand for oil and gas and supply. So COVID-19 gets the first of the things underway. And more importantly, with COVID-19, what effect on global demand? Over less than 3 months, we've lost as much as 30% of global demand, of which is 100 million barrels a day. And how much is it going to be for the longer term? There are obviously plenty of people who are around saying this will change things forever. It may, to a certain extent, a lot of industries will be lethargic. Some industries, the return to work is possible, but in some industries, crucial to the oil industry, such as in airlines, leisure and travel, the return will be slower. You mustn't forget that, of course, with the international lockdown, there has been little driving around. A lot of people hate to be reminded that on the odd occasion they do go out for essential journeys. Here in the UK, the gasoline price got down to £1 a litre. It's certainly 70 cents a gallon off in the States, but you're hardly doing any driving, so it doesn't make a lot of difference. OPEC Plus is the next point, and the way that OPEC Plus moved during this process was of most interest. OPEC Plus had a technical meeting. The first one was only on the 17th of February, and ironically, at that meeting, they recommended that already they'd seen global demand falling rapidly and recommended a 600,000 barrel a day cut. Russia, 4 days later, on the 21st, said there was no need for an early meeting nor any cuts. And the next meeting didn't come up till the 6th of March. At that stage, the technical committee recommended a 1.5 million barrels a day cut for ratification on March the 7th. Ironically, Russia again said no. Their famous phrase was "April is a free-for-all." That day, March the 6th, oil was 41 and 45 for West Texas and Brent respectively, at which stage the Saudis really did throw the toys out of the pram. And they cut their list prices by 20% that night. And the following morning, the oil price had fallen $10 a barrel. Supply is obviously the next part of the equation. I think you would say double the downward bet. Really, the Saudis announced a target of 13 million barrels a day, which no one thought they could get to, but they apparently got into the 12s, having been at about 10. So that sounds fair enough to me. And then it wasn't until the Easter meeting, the virtual meeting that they had, that supply was taken seriously as the oil price was taking a proper caning. The big questions here, of course, within OPEC and OPEC Plus, is whether all the protagonists will stick together. One of the problems that we've had all the time up till now was that US production never really changed. Indeed, I'll probably come back to it, but in a previous incarnation in 2014, when the Saudis went for market share, it didn't work because they didn't get the price down far enough, and therefore US production didn't come off. It has now. Russia has come into line. Production has already fallen a bit. They're usually quite slow off the mark to adhere to their quotas, but they seem to be doing okay. The bottom line is that this group needs to be absolutely rock solid and tight all the way through to the end of the year if they're going to draw any stocks which have built up in the last quarter. Next key thing is storage, which has become a huge issue, and I know we're going to be hearing about it a little later on, so I'm not going to say much of that. Immediately after the 20% reduction in prices, Saudi Aramco went into the market and hired as much as 35% of all available VLCCs, and they created what they called a floating storage of 50 ships, which can take 100 million barrels a day. More importantly, not just to take their crew, which they were increasing, but to ensure that it wasn't available for anybody else. The phrase that came to mind from the IEA was that the next few weeks would test logistics capacity to the limit. And there's no doubt that I think our guy will be telling us about that in a few minutes. The next point is the influence of the USA in all this. I've briefly mentioned it. Year-end production was just around 13 million barrels a day, which was there and thereabouts the high. My forecast had been that it would fall a bit. When this started, I thought 1 million barrels a day off by the end of this year and another 1 million barrels a day off for next year. But right now, everything has changed, and that million has already come off. EIA predicted another 1 million barrels by the end of June, and this time the US did really realize it was their problem. The bottom line here is that when Trump put out the tweet, "Oil is cheaper than water," it wasn't just the OPEC people that thought it was amusing, because it wasn't very long ago that Trump was trying to get the oil price down so that he could have a cheap run into the election on gasoline prices. How things change. But at that time, then Putin, we knew Putin was on the move because he then said, we need to address challenging oil markets. OPEC agreed to meet over Easter virtually, and agreed a series of substantial cuts. No one quite believed that it was what they said it could amount to 15 to 20 million barrels, but because it started on May the 1st, so you were talking about 6 weeks later, and then you had more crude on the sea, we were going to have a pretty rough time from the middle of April till all the way through to sometime in May when that storage is beginning to work down. The next headline is investors, and I don't normally put investors in as part of the process on the oil price, but they had a very important role to play here, because private investors and big hedge funds and so on, they all think that they can judge the bottom of the oil market, and usually you're not far away, but you have to stand hard, like being blind in a three-card brag game, because it takes longer to work through than you think. So the most famous problem was people who were invested in ETFs, and the most famous being the USO fund. So the 20th of April, which will be etched on everybody's minds for the foreseeable future, was expiry day for the May WTI contract. And as a landlocked crude with settlement in Cushing, Oklahoma, the writing was beginning to be on the wall some days beforehand. Rumors in the market later, I think, proved true that USO fund that we mentioned had 28% of the open interest in the May contract, which it was just unable to do anything about. And the 2 days beforehand, Texas crude was trading at $4, was clearly going to be worse. And of course, at that stage, you are in between a rock and a hard place. Fortunately, most people had Trafigura and one or two other of the big oil traders to come and help them out by taking the oil off their hands, but you had to pay them $37.30 or similar to get out. And finally, those who bought the commodity direct, money market managers and the hedges that they're now called, responsible for what's called NSL, net speculative length. The beginning of March, that was 118 million barrels of West Texas crude at a price of $47. I checked the number last night. It's now 341 million barrels, which is a combination of 177 million barrels of gross length and a reduction of 46 million barrels of the speculative short positions, and that's at $25. So if you bought it on the average at 47, you're still losing money at the moment. Briefly on this then, winners and losers. As I say, unlike in 2014 when the Saudis attempted to gain market share and failed, this time they have proved that the US shale patch, built on high debt and high costs, and at any sort of price, even anything sub 40, a lot of it falls. It maybe not get out to 5 million barrels of production, but somewhere close, and that will give them the scope. Maybe lose 2 or 3 million barrels this year, and maybe a bit more next year, for a very tight OPEC plus to make their figures work. As I said, 12.8 million barrels a day at the beginning of the year, could be 8 million barrels a day by this time next year. And finally, back to the question that everyone got asked. My own view on the oil price at the end of the year has been, I chalked a new price in last week. I'm on $40 a barrel at the moment. Anything can change. I'm not noted to be always at one end or the other of the price range. Today's announcement by the Saudis that they've taken a further cut, bringing them down to 7.5 million barrels a day, is a pretty heroic, near 5 million barrels off the top. They need to keep it up, so $40 may be a little bit too low, but that's where we are on that. I've been asked to say a few words on oil companies. I'm going to say a few words on the the majors, I don't think there's too much to say. They always cut, in these circumstances, cut capex substantially. The range of 20 to 40% is not unusual. Exxon have said 30%. This is from 30 to 30 odd billion dollars. Chevron are taking 25% off, and both those companies have said their dividend is sacrosanct. Even Aramco have said that they're cutting back capex, but ironically, unsurprisingly, their preferential dividend stays. The most striking thing of all these companies, obviously, was for investors who saw that the Shell cut the dividend first time since the war, and certainly not what people expected, me included. It may be a very exciting signal to watch. I suspect that a number of the majors have felt burdened by their payouts for some years, but have been unable to countenance it. It needed somebody to, if it's not too pertinent, to break the dam. And this price crash, which we're no means out of yet, might have been just the excuse that they needed. A rebasing of the dividend is probably what you might call it. And if they're not the first to do it, I think only Equinor and, of course, the hapless Occidental have done it as well. BP must be feeling very exposed. The opportunities they've had to rebase and cut the dividend have been, well, two significant ones recently. After Macondo, when they, in absolute state of madness, increased the dividend out of sheer bravado, and recently, they put a few coppers on it in their last announcement, which I thought was just completely unnecessary. No point in discussing the service companies or the US onshore companies who are in a terrible state. So I'm going to go on to very briefly, Jeremy, just have a quick talk about the alternative bucket list. We've always had a bucket list in the blog. This is a combination of different companies that might come out of the previous crash or do well in a selection of scenarios. This one is particularly for this scenario. It's a bucket list, you might say. It contains companies with serious defensive characteristics, and we want most of them to come out of the other side. So I have got 8 stocks here, which I think are interesting. I have Rock Rose Energy, run by Andrew Austin, very strong position in the North Sea, just completed a big acquisition of Marathon Oil UK, very, very strong on cash, 339 million of cash. Market cap's only 125 million, tells you all about that. He's done a buyback, one-off dividends, and now he's a regular pair of dividends, so you get dividends there. Diversified Gas and Oil, who did a deal this morning, is an onshore US company, but one with a unique production-only model that continues to deliver because it's got thousands, tens of thousands of stripper wells in the northeast of the States. They're yielding 10%, just over 10.5% the deal today, and they've come up strongly since the oil price fell, and they're one to seriously have a look at. IOG has had a very difficult couple of years, particularly financing its core project in the southern North Sea, but it's now very well placed. It's financed for the gas development. It's got a partner, Cal Energy, which is part of Berkshire Hathaway, and it's got gas coming on stream at the end of next year. As gas becomes more important in the UK, so will it. Genel Energy is the next one, which is in a very strong financial position, despite the fact that the KRG is clearly influenced by the OPEC cuts in Iraq. But Genel have got a very strong project base, and they are very happy to pay a dividend that was yielding 15% when they declared it. So we know that the old rule that if you go a high dividend looks like it's going to be cut, it certainly doesn't look like that at the moment. A couple of others. Predator is one which is so small you may not have known much about. It is developing a CO2 enhanced oil recovery project in Trinidad, which has the scope to be very substantial, especially compared to the size of the company. And it would catapult the business into being a genuinely low carbon player. And in the years to come, you want to have these low carbon players, and it's waiting to drill an exciting onshore gas prospect in Morocco, subject to the virus situation. And Rehobold Resources, which has got part of the really exciting West Newton oil and gas field onshore the UK, which when that goes ahead, it's going to be very substantial indeed. And I'll finish up with a company called, got two more actually, Wentworth Resources in Tanzania. Is a great company. It's paid back all its debts. It gets income by selling gas to TPDC, the Tanzanian company, and other operators from its Mnazi Bay operation. It has long-term fixed price gas contracts, which, believe it or not, are priced against the US inflation number. You couldn't guess that in 100 years. Pays a dividend, yields 7.5%, very well run, Wentworth. And finally, Serica Energy, that's the last of the 8. Very smart North Sea operator, consistently delivered under a very smart CEO called Mitch Flagg. They bought the Bruce, Keith and Rum fields from a combination of BP and Total and so on 18 months ago. And they've just delivered a cracking set of figures in difficult circumstances and announced a maiden 3p dividend. So, Joe, that runs me through as many as I can. I hope I haven't overshot. I'll take questions and leave it back to you.
Yeah, hold on there just a moment, Malky, because I also want to ask a question, not from the floor, but from me, because you spoke about your thoughts on the price of oil. You're going for $40 at the back end of this year. I just wanted to find out from you as to whether or not the way to get there is going to be very volatile. And I want to push you on this point. Have we seen, in your opinion, the lows this year for Brent or WTI?
Yes, I think that, I mean, I'm not going to put the standards of all things being considered. I think we are past the worst of it because we're going to see continued fall in US production. And we get the impression that the players within OPEC Plus are going to hold tight. What you then need to see them do is to take away those huge stock figures, which are all around the world. We know it's full at Cushing. We know it's full on tankers. We're going to hear about that later on. So I think that they'll stick tight. I think that we'll get wobbly moments because we're going to run into times when for example, the next expiry of the WTI contract. But it won't happen again. Let me tell you that the Black Monday won't happen again because, for example, the ETFs have all cut back their exposure to the front months. So there's very little exposure to the front months now.
Okay, well, we'll take a look at the futures markets and the spot market in some more details in just a few moments with a guest coming up in the next 10 or 15 minutes or so. But Malky, thanks indeed for that. Stay there. We'll be back with you for the round table in just 10 or 15 minutes time. So now up next for us here this evening on this Tuesday is Roy Kelly, a petroleum engineer, board member of Hurricane Energy and a newly appointed chief executive of Victoria Oil and Gas. Now, he's formerly managing director at RPS Energy and an upstream consultancy and partner at Keragen Capital, which manages $2 billion across multiple funds. Roy is with us now, and he comes to us with 35 years experience as a professional in the business. Roy, it's good to have you on the panel this evening. I'll leave it up to you to take it away for your presentation.
Thank you, Jeremy. Can you confirm that you can hear me and see the presentation?
Both, I can confirm that. Yes, indeed, we've got the presentation in front of us. We're looking forward to receiving it. Roy, over to you.
Thank you very much, Jeremy. Hello, ladies and gentlemen. And a big shout out to IG for organising a wonderful event. I really should be the warm-up act to such erudite speakers as Malcolm Graham would, but hey ho, they got the order wrong. There's the inevitably illegible disclaimer that my compliance department insists on as a CEO of a public company. So in outline, just some quick introductions. The lens through which I look, I'll explain in a minute, is really from a small cap lens. I'll give you some thoughts on oil and gas and oil versus gas and the situation we're in. And I was asked to just take a look at Africa, not just because I'm the CEO of a largely African player. So very quick introduction. I think the logos on the bottom right say it all. I recently joined Victoria Oil and Gas PLC, an AIM company, as CEO. I'm also non-exec director of Hurricane Energy PLC, which is a UK West of Shetland fractured basement specialist with production. I'm also a consultant to Carrigan Capital, which is a specialist private equity fund with $2 billion assets under management. I spent a number of years in advisory roles as well as training with BP and a number of independents as a petroleum engineer, and I still carry the card, so to speak. So a quick word on my current employer, possibly not very well known. It is a small cap on AIM with main asset around the town of Douala in Cameroon, which you see on the bottom right there, with ongoing natural gas production and condensate sales. The natural gas sells at prices which, compared to NBP and Henry Hub, we'll discuss later, seem remarkable, but they are on long-term gas contracts, and they're displacing heavy fuel oil and diesel, which would largely be imported. I also had as an oil discovery asset in the Yanao region of Siberia. Recent news is continuing operations at Logbaba, where we produce several million standard cubic feet a day, sold at a weighted average of approximately $12. Don't quote me, because that can vary on a daily basis, let alone weekly. We recently announced a non-binding letter of intent with both New Age and AXA to take offshore Cameroon gas and deliver it to an onshore power generator. So that's kind of an infrastructure and intermediary role rather than just an upstream issue. And over the last year, the board has changed, of which I'm the most recent change, and addressing a number of legacy issues and threshold issues that the company suffered. So I've done this at a glance. I'll say more words to this. So I've kind of done a before and after, and excuse me, I've lost my screen, Jeremy. Excuse me 1 minute. If you think of before, sorry, Jerry, I've lost my screen.
It's okay. Are you? We are seeing the reaction of E&P companies to COVID-19.
Yeah, I'm just going to. It's gone again.
Do you want me to bring up the presentation that we've got?
That's okay. I just can't see the script. So I've done it before and after, and basically I don't think very much has changed, and that's through my lens. Obviously, I was trained by a major, which at the time was a monolith in the 80s. It's less so now. But we were in the era of fortress balance sheet anyway, in my opinion, towards the end of the next year. Well, I'll show some pricing which indicates that. We were in the era of cash preservation and cash is king, to quote Warren Berkshire Hathaway. That hasn't changed. Remember, Tullows dividend cut was last year in response to specific issues in Africa and the North Coast of South America, and that would hardly be called a large cap. We were in the world, in any case, of major cuts in capital to reverse that gas, and in the intense focus on safety and well-being, colleagues, contractors, and the environmental push. So that was on us anyway. That's exacerbated. Certainly in the companies I dealt with, and there were dozens in my private equity life a few months ago, and small cap, there was a constant drive for efficiency, meaning production optimization at lower OPEX without cutting any safety corners, of course. Add to that a greenwashing of credentials with intense pressure from the lobby. I'd say that's at the same level. That's the only one where I've given a single tick after in the post-COVID-19 era. So what do I mean by much hasn't changed? Well, the plots show from the EIA show Brent spot, FOB, spanning what a very long time, 1990s to now. And Henry Hub obviously a landlocked gas price. But you look at Brent and Henry Hub, they're on the way down. So the first case of Corona is just within the red circles I've driven. So in any case, we were way off the $100 to $110 a barrel euphoria of 2011 to October 2014. We were seemingly on a downward trend. So those cash preservation, whether you're paying a dividend or not, and sadly I'm not in the company that pays a dividend, we had those pressures anyway. And it's what I call, we had a perfect storm to which COVID and the OPEC and the price wars have added. But we had oversupply, we had the embryo of a price war, quite intense ESG pressures, which I think are natural and there's nothing wrong with them. And we had in the world, or a wet market in China, however you want to look at it, added COVID-19. So that's why I say, in my mind, there's, as someone like Malky who's been through multiple cycles, down to $8 a barrel in 1987, we have the natural cycle, then we add the black swan event, if you want to call that, COVID-19. So I wanted to talk about, what I thought about coming out of this. I mean, I'm not going to read through these headlines, but we are, the world's going through a vast economic disruptive event. I read this morning when I was researching this, we're talking about a well-known university in New York is talking about $1 trillion a month reduction from the US GDP, which is a $21.5 trillion GDP, I know, but $1 trillion a month from the GDP as a result of mitigation measures until those are relaxed. That is extremely difficult to come back from. And you'll see the headlines, the worst since the Great Depression. That's the generally economy, because the economy and growth and people's personal as well as macro wealth is, of course, the engine room for us oil and gas explorers and producers. So just a few words on oil versus gas. I don't have Malky's crystal ball. I'm less wise than him on predicting these things. I think it may not be far off in his 40, but there's no real consensus. I took a consensus of 12 people who do this for a living, and the year-end range itself was plus or minus $25 when the oil price is only just above $25. So that's the uncertainty we live in. We talk of oil as a global product with kind of market pricing, and that's true in the main. There are exceptions. There are specialist oils, in particular heavy oils and tar sands, where that's not true. And there's a much more localized pricing of most gas. Of course, the shipping LNG has changed that for all time. So the political backdrop, the House of Saud, which has a huge interest in the price of oil. We were discussing this earlier. IMF is still saying that the Saudi has a fiscal break-even of $80 a barrel. So Saudi Arabia will not be enjoying this period of time. And if you add to that some OPEC members like Iran and Venezuela with fiscal break-evens at or north of $90 a barrel, these people are feeling pain like the rest of us. So there's some underlying issue of increasing ESG disclosure and behavior, and I don't mind that at all as someone who's worked on drilling rigs and production platforms. Safety is paramount, environmental protection is paramount. It always has been. There's been no harm bringing that to the fore at all. I think the down cycles tend to increase focus on that, as that's not a bad thing at all. That's all I'd say to those things. So I've given a shout out to Africa, as I would as the CEO of a company whose main asset is in West Africa. Just a quick snapshot on the impact of COVID. So that's the Johns Hopkins University of Medicine map. They're not proportional circles, but if I just point at what 2 days ago, there were 10,000 confirmed cases in South Africa, which was the worst by far in any African companies, including 194 deaths. Now, South Africa, I want a shout out to them, which is the bravest government in the world because they banned the sale of alcohol. If they try that in towns near me, I don't know if they'd be right on that. But the continent was ready, particularly West Africa. If you think of 2014, 2016 Ebola outbreak, which had a 50% fatality rate, according to the World Health Organization. So in early February, West African, if you flew out to West Africa, which you could in early February, a lot of international airports there, you would be met by airport staff in hazardous materials. So they were ready for this, and they almost to a man locked down, including closing borders, which of course developed nations are loath to do, very early. I can't say whether that's helped or not. I mean, only time will tell on that. But with the highest number of cases in one of the 54 countries in Africa is 10,000, you can see what they've done. Effect on the oil and gas industry, of course, the free flow of equipment and personnel, that's hurt us personally in VOG. We were unable to complete the work over a key well. We need international borders open to complete that. Some of our customers are unable to move people in or products out or raw materials in. So that's affected their demand, which in turn has affected our demand. Of course, you keep production going and you harvest production in these times. Some countries have already eased lockdown rules. You can be your own judge of whether that you think that's premature or not. I think that might be a tad premature, but that's the state status in Africa. So why Africa? I sound like I'm a marketing man. I don't mean to be that. Firstly, it's bloody huge. It's 54 countries, and the United States and China easily fit into it. It's a fifth of the world's land mass, and it's 5,000 miles approximately from north to south. The key is for the engine of growth, a growing population and a population which is actually getting younger. From a geological perspective, someone who works with geologists all the time, it's got a very large number of geological basins with a surprisingly low well density in some of them. So you may not know, some of you may not know, it's got a century of oil and gas investment activity. And most of those countries, whether you can consider them true democracies or not, with overstaying presidents, it's got a century of investment activity and free trade. And you can expatriate funds, and you go back to 2015, a really, really bad year with the oil price crash. There were still M&A deals and farm outs throughout Africa, more so than in many parts of the world. So don't just take my word. Just looking at these two seminal pieces of work, I think they were published in November of this year. I won't read them out. Some of the astonishing statistics are that 500,000 people will need cooling or air conditioners by 2040. I know that's 20 years ago, but in geological time, that's not a lot. The average age of Africa will be 12 years younger than the global average by the same token. And they're undergoing the largest scale of urbanization in history, larger than that in China over the last 10 years. And its oil consumption to 2040 is larger than China. So some quite astonishing statistics in growth. Even if they're 30 to 50% out, it is a forecast, of course, but by some very clever people. That's still a growth engine. And talking of gas, obviously I'm CEO of a company largely relying on gas, but we speak to developed markets and Brent at a low. And what you see is a very, very surprising rate. Now you can find these in the public domain, as I did in the last month. So I told you my company is selling gas at a volume weighted average of approximately $12 per million BTU, which is approximately $12 MCF. That's because these are long-term gas prices in a localized market of a net importer of these things, and we're displacing diesel and heavy fuel oil, which is still being imported at prices north of $20 per million BTU. So at $10, those consumers are still getting a saving. Obviously, there are outliers in the energy balance. There is countries dominated by hydropower, which is Angola, which is a net exporter, of course, and surprisingly, flares and vents nearly all of its associated gas in what is a largely offshore industry. Nigeria, of course, is the $2 an MCF because it's rich in resources, and developing a gas market and a net exporter. So there's some outliers there. They're generally, and of course, South Africa is dominated by coal. If you look at the continent as a whole, you can see the dominance of biomass, solid fuel in the main, and coal. If I took South Africa out of that, which dominates that coal piece, that would look very different. It would be biomass and natural gas. And if I took that back 10 years, you'd see natural gas doubling over that period. So just a snapshot of what's happening in commodities in Africa. And that is, of course, that is on a map that's a night vision. You see there are not many lights in many of those 54 countries on at night. And that's the growth aspiration of the country. So to the IG's very good question, has it changed forever? You've probably got a sense that I think it's always in this constant state of flux and evolution, is it not? The natural cycles that Malky and I have been through in our career, so they're hard enough to deal with anyway. But this year's perfect storm will take some time to recover from, and that is not months, in my personal opinion. I did have something on trading, but with some very better educated and experienced traders who can talk later. There was 160 million barrels of oil at sea on April the 20th. I'm sure the trading experts will tell us where that is. That cost $30,000 per day per tanker. So we are in a very, very strange place at the moment. It's quite unique in what is happening at the moment. When Saudi last took on US shale, it forgot about one or two things. It forgot about ingenuity. And my collage image to the top, which I used on a recent presentation, is the ingenious, that is the world's first commercial CNG vessel operating in Indonesia now. And the bottom right is the world's first commercial LNG vessel operating offshore Cameroon, as it happens. That is the device that looks like a 10p piece is the size of a 10p. That's a completely autonomous inflow control device that automatically cuts off gas and water production in high angle wells, which is with no intervention whatsoever, an invention of the last 10 years and being heavily spun out. And that is a drone deploying seismic receivers in hostile, remote or rough terrain, all inventions of the last 10 years. And that ingenuity will now be tested to its full, for sure. And add to that ingenuity the oil industry's ability to reinvent itself. And I just pick out the North Sea unit OPEX. I'm the non-exec of a North Sea company with OPEX down at approximately $17 a barrel, but the unit average is $16 a barrel. And I can tell you it was twice that some 10 to 15 years ago. So that is quite an amazing achievement. Just my last point, for the safe production of efficiency and cost savings, and this social license to operate, whether you want to call that ESG pressures or what, I mean, that's been of paramount importance, if not in all, then in most of my 37 years. And whether as I've been a director of a company or a technical practitioner, that's always been foremost in my thoughts. So I'll leave you with that. I'll just leave you with some pictures just to remind everyone that the oil and gas comes from highly complex underground geological systems, and they should own the uncertainty. This turbulence and uncertainty we're seeing at surface is highly unusual, and really the rock should own the uncertainty. I'd love to take your questions at the end. Thank you very much. Hand back to you, Jeremy.
Right, thank you very much indeed. Very interesting, and I'm sure we'll have some questions for you as Chief Executive of Victoria Oil and Gas, but also as a non-exec director of Hurricane Energy. But I'd like to get back to you as well a little bit later on with some questions as well, comparing and contrasting the difference between oil and gas. So we'll get back to Roy in just a few moments' time after we hear from two IG contributors this evening. And I think if we can switch cameras now and bring in our next guest, it's a friend and colleague of mine here at IG, Josh Mahoney. Josh has recently been interested in the area of oil storage, and will impart his understanding of what's going on in this area in just a minute. But Josh is first and foremost a technical analyst and going to look at how to trade these oil markets. Josh, over to you.
Hey guys, hopefully you can hear me. Let me just get up my screen here. Alrighty,
yep,
so
you're good to go, Josh.
All good? Okay, cool. Right, yeah, so I mean, look, I'm in the company of some pretty esteemed guests here, so they certainly have covered a lot of the things that I'm talking about here. So I'll try and breeze through certain points, maybe focus on other points that might be a little bit more useful. I guess when we're looking at what the current issue is in terms of the oil and gas market, and particular, or the problem here is all about demand and supply. Of course, we've seen a huge amount of destruction in terms of demand. We've not necessarily seen that on the supply side. That pretty much culminated when we saw the minus $37 pricing on the front month on the May WTI contract. And since then, we've essentially seen a refocusing, I guess, on the supply side in terms of trying to realign the two sides. This is something that I think is going to continue to play out as we move forward. Producers potentially cutting further as they try to support prices. We've seen it in terms of Saudi Arabia both today and yesterday, announcing that they have been pretty much overcutting, saying that they're going to do an extra 1 million barrels per day extra, talking about the possibility of further cuts from OPEC when they meet in June. That is likely to be an ongoing theme, and I think it's an interesting one because of the fact that, of course, when we saw the likes of the Saudi Arabians and the Russians really going at it and trying to have a little bit of a war, there was this talk of the potential that both sides were essentially trying to bankrupt US shale. Whether that wasn't necessarily the case on the Saudi side, or whether Donald Trump or something else has made them change their mind, they appear to be back on board now with the fact that they're apparently leading the way in terms of this move in regards to actually supporting prices once again. Of course, Saudis have always pretty much been front and center of being supportive of prices, being pretty much the mainstay of OPEC, and what they say seemingly goes really for OPEC. I guess the frustrating part has always been the fact that the likes of US producers can pretty much do what they want and piggyback on this rise in terms of oil prices, whereas you're seeing those production cuts from some of those OPEC members. Of course, now we're seeing that shift in terms of OPEC to OPEC plus, and that seems to be growing over time. And that's certainly something that has to hold together as we move forward. And the demand side is also going to be really interesting. Look, as things stand, you know, we're over in the UK here, we're preparing to be able to at least drive to the beach and be able to drive to further destinations. We're gradually seeing the world open up little by little. But there are some caveats to that, and I think that, you know, without this vaccine, this idea that somehow we're moving back to normality, I think should be questioned somewhat. You know, we've seen it in terms of Germany and the R rate moving higher, and over 1 in particular, meaning that we start getting exponential growth once again. You're seeing Wuhan, where we're seeing a rise in terms of cases. Singapore, which initially was a poster boy in terms of how to control the virus, now seeing a strong rise in terms of cases. So I do think that demand as we move forward is likely to remain a significant issue. And I guess when we're thinking about the supply side, it's about whether they're actually able to continue to really hold back supply to be able to really elongate the upside that we have been seeing over the last few weeks. Now, in terms of what we want to look at, I'm going to just show you a few charts first and foremost. This is the sort of outlook for demand over time from the IEA, and you know what we can see is, by and large, the expectation is that we're past the worst. Now, the interesting thing here is that whenever you see people forecasting demand over time, you're always seeing something like this, right? It's a single wave. We don't necessarily know that that is going to be the case. We don't know if there could be another significant wave of COVID at the back end of the year, in autumn, in the winter. We're not necessarily sure of that, and so certainly that is something that really is going to influence the behavior within markets. Now, bear in mind that people that trade don't necessarily trade on the here and now, and we've seen that evidently throughout stock markets recently. Ultimately, people weren't necessarily trading on the fact that we saw a minus 20.5 million NFP number. People didn't really care that much when we saw an incredible decline in terms of the rise in unemployment, the rise in terms of jobless, because people are always forward looking. And so I think at the moment, as we're moving towards this phase where everyone's becoming more optimistic, we're seeing a reopening, the potential thing that could hold back stock markets is the same kind of thing that could actually hold back oil prices down the line, where you see the possibility of us going backwards once again, rather than this idea that we've got here with the chart from the IEA that, you know, once we've bottomed out, it's plain sailing from there. There is a good chance that we could see further volatility up ahead. Of course, the Saudis are very important in this, and we can see here in this chart that actually, we are seeing a significant amount of movement from the Saudis in terms of being able to try and control some of these prices. And I think that's going to be absolutely critical as we go forward. Like I said, OPEC by and large fall in line with what the Saudis want them to do. And the Saudis usually take the biggest hit. As long as they're willing to take it, it feels like you're likely to see the rest of them fall in line. Whether we see that really spreading across to other nations remains to be seen. Of course, Russia has become a key part of that OPEC plus alliance, and a number of other countries also coming into that. And if you're looking at the possibility of up to 30 million barrels coming off per day in terms of demand, then you've got to start looking at where are we going to see the supply really shifting. Now, I do think we're moving towards something like a more balanced market, and you've seen that in terms of some of the shut-ins that we're seeing over in the US in the wake of that -37 print on the front month contract. Ultimately, people can't necessarily continue to create a product where we don't necessarily have the demand for it, and they're not necessarily getting the price that covers their cost. And so I do think there's going to be a natural balancing as we move over time. The question mark is that, as we're talking about, where could we be at the back end of the year and the like, if you don't have the demand, right, you're likely to move into a period of time where, okay, let's say markets continue to get ahead of themselves and always looking ahead to this idea that in the future we're going to see a big ramp up in terms of demand. Well, quite frankly, if prices move high enough, then you're just going to see a significant rise in terms of output, in particular from US production, and therefore you're going to move back into a position where we're seeing this huge glut. And you can see in terms of inventories over in the US, certainly we're tracking that change in the inventories week on week at the moment. But nevertheless, you can see here, whilst we're seeing a slowing in that rise, we're continuing to see that rise. And of course, as we move towards the back end of this week, we've got on Monday, the end of the current June contract on WTI. That, of course, came to a head when we were looking at the end of the May contract. Of course, the problem there was the idea that essentially there wasn't necessarily as much storage as they needed. And, as has been alluded, it does feel like that was the wake-up call that allowed people to essentially reconfigure themselves for the upcoming, essentially, end of the contract. You're seeing open positions essentially falling for the contract and people shifting onto the latter contracts. And so there's less likely there's less of a likeliness that we're going to see ourselves back in negative territory. But nevertheless, I guess half of it is what's going to happen in terms of the nuts and bolts of it on the ground over in the US. Remember, the problem with the US crude, WTI rather than Brent, is the fact that WTI it has a physical settlement. That's not necessarily the case in terms of Brent crude, and so you do have the problem that if there's nowhere for it to go, you're essentially paying someone to take it off your hands. The question mark is that going to happen again? And remember, if we look back to what happened on that fateful day when we saw that prices ultimately settle at -$37, it started to ramp up very quickly towards the back end. So it's something that is really happening on the ground. It's not necessarily just something that as a trader you're looking at your chart and thinking, oh, this is great, everyone's trading it and it's moving in one direction and sentiment's really moving. This is to do with people on the ground and their ability to be able to sell the product and find someone at a given price. And so that can happen really at the back end of that contract. It remains to be seen whether we're going to see that move, but also you have to bear in mind the sentiment around this. Look, if we do move closer to that contract, you're going to likely see greater fear of that. And if we don't see fear of that, I do think if this hurdle is one of the major things that's holding back oil prices at the moment. If we see people continue to fear the idea that we're going to see a crash in terms of oil prices like we did last time, I think that's likely to hold back the market. But we haven't necessarily seen much of that. And the fact that we've actually seen significant strength over the past few weeks really does allude to people feeling a little bit more optimistic, people being willing to buy into the sort of idea of the future being better than the present, I guess. If we're looking in terms of what's happened since the end of that contract, if we're looking at the sort of front month contracts, you can see the outperformance is in the green line, and that's on the front month contract. And so you can see that actually you would expect to see it underperform if you were seeing people really fearful of the idea that this is going to be the contract that really does suffer the most. We haven't necessarily seen that. And therefore, this alludes to an idea that actually we may not necessarily see that front month contract fall into negative territory this time around. Just going to bring up, let's try and get my charts up. There we go. So this is Brent. I'm going to bring up WTI just because that's the particularly interesting one at the moment. Now, what we can see here is, I mean, if you look from a historical perspective, you can see just how cheap things have got, quite frankly. And, you know, I mean, I was saying this around about your 30 to 35 to 40. I was saying this by historical standards is very cheap. And I guess this is why everyone's been looking to try and find one way or another to be able to get into these markets, because quite frankly, we're not going to be in this position in a year's time. And so, you know, people are looking different ways. You know, we were talking earlier about the USO ETF, and there are innate problems with that ETF, quite frankly. Ultimately, you do see destruction of value over time. But if you see a market that is as volatile as we have seen recently, that can overshadow it if you buy it at the right time. Of course, the other way to do it is essentially to be buying into oil companies that are well capitalized. And certainly these guys, in particular, Malky knows more about which companies to be looking into specifically. But certainly you have seen that, you know, if you're looking in terms of the declines in oil prices versus the declines in some of these oil companies, they certainly haven't been anywhere near as much. And that's because of the fact that people want to get into this oil rally. They know that it is a temporary move. But certainly if we look at this monthly, you can see that decline that we saw at the back end of last month, I think is likely to be the lows that we've set. The weekly time frame showing you that radical ramp up that we've seen recently, but we aren't necessarily out of the woods quite yet. This daily time frame showing you that we have essentially been consolidating around that 76.4 Fibonacci retracement thus far. The 3157 level is really going to be key for me. I guess the difficulty here is that we're faced with the fact that when we break the 3157, it doesn't necessarily mean that we're out of the woods in terms of the fact that the demand and supply picture still remains challenging. And so there is a possibility that when we do see that break, it's not necessarily going to see this huge ramp up instantaneously, but instead gives you a phase of, I guess, bottom building and a phase where we're not necessarily seeing as much volatility, I would say. You know, certainly the volatility has been incredible recently. I think once we do manage to overcome this hurdle that comes with next Monday and the fear of a potential negative read on that front month on the WTI, once we get over that hurdle, I think we're likely to move into a little bit more of a bullish phase if that is overcome, but also likely to see some of the volatility come off. On the shorter time frames, we can see on, say, the 4-hour chart that actually, by and large, recently we've been seeing a distinct lack of volatility within a range around about 23.84 up to 27.39, and really the trade here is around about the breakout from this. Of course, we've been regaining ground, but we're still remaining within this range, and so the breakout from this, in particular, I've been looking for a break through that 23.84 because it's a notion that traders think that we could get into negative territory. Even if we don't necessarily do it, from a trading perspective, there's a possibility that we could see this market sell off in a meaningful manner at the back end of this week, just based on the notion that we could see negative rates rather than actually seeing itself. So certainly I think we're going to be in for a relatively busy few days ahead. Monday evening is going to be the back end of that June contract. What we do around about that, I think, is really going to set us up, because that's going to be a significant amount of fear in terms of what's happening with the markets at the moment. I just want to also briefly take us through a few slides with relation to the storage space at the moment, in particular in terms of floating storage. This has been a particularly interesting story of late, just because of the fact that, quite frankly, storage is running out. Suddenly people need to put their product onto ships. Now, essentially, tankers are probably going to be your storage point of last resort. Well, apart from trying to fill up trains and the like, which it seems like people are trying to do to try and avoid the costs that are associated with it, because they're particularly expensive. Now, that becomes more expensive as you see a widening in terms of the contango. So the price of the front month through to further months in advance, people were able to buy a particularly cheap front month price and then hold it in some sort of storage to then be able to make a significant locked in profit down the line. So if you see a significant contango between, or a difference between your front month and your later months, then that essentially is the amount that that's going to determine the amount that people are actually willing to pay the tankers to be able to store their product. That has significantly shrunk since we saw those lows set at the back end of April, and that has had a significant impact on tankers. Now, one thing here is, the caveat here is that overproduction and oversupply hasn't gone away, and it isn't going away anytime soon, I don't think. Look, ultimately, we're still continuing to build inventories over in the US, and that really does allude to the fact that we might be moving somewhere close to some sort of equilibrium. But even then, we need to go over and above the equilibrium to start taking some of the oil out of these onshore tanks, out of some of these ships. And until then, I think there's going to be significant demand. Now, if we're looking in terms of the rates, you can see here that actually, for the most part, most of the rates have come off really heavily over the last few weeks, and that's pretty much since we saw the end of that May contract. They've been on a downward trajectory. The two that have been holding up relatively well have been on the clean front, and so that's the LR1 and the LR2, bearing in mind that they take different products, so they wouldn't necessarily take the dirty crude. They'll be taking things like jet fuel or gasoline, things like that. They've been holding up, and they're at historically very high levels at the moment. Whether that's going to follow or not remains to be seen. If we're looking at pricing in terms of the tankers, they've been hit hard because of this decline in terms of rates, and this idea that, you know, we were going to see $250,000 per day for ships that, you know, previously were taking $30,000 per day. That previously ecstatic position that markets had been having has essentially faded, but I do think we're likely to move into a phase where we see, so this is essentially representing the same thing, and that increase in floating storage over time. I think what's likely is that we're going to be moving away from this phase where we're concentrating so much on this idea that we're going to see huge returns, and into a phase where people actually realize that even at these relatively depressed levels in comparison to where we've been just a month ago, still do represent a significant increase on where we have been in terms of averages. And if we're looking here in terms of the order book for tankers, we're seeing all-time lows for new tankers coming into play. We've also got 101 VLCCs turning 20 years old by 2022. So you're seeing a tightening in terms of demand. In terms of supply, it's not going anywhere at the moment. Like I said, we're continuing to see an oversupply in terms of global oil. It needs to go somewhere. And at the moment, a lot of that, of course, is at sea. And until that's actually being resolved, I think it's likely that we are going to see continued demand for tankers, and that should find some sort of equilibrium. This is a number of different tankers in terms of their pricing. You can see significant downside over the past week or so, but I do think we're likely to find some sort of bottom soon enough and start regaining ground as we really adjust to this more sort of normalized pricing, albeit at, I would say, higher than historical prices in terms of tanker rates.
Okay, Josh, thanks so much indeed there for joining us. Stay there, Josh. We'll be back with you with the rest of the presenters in just a few moments' time. What I want to do now is to bring in the last guest, but as I said at the top, certainly not the least important. In fact, on the contrary, this is one of the really big things that people have been talking about, and that is the IG platform, how we deal with the mechanics behind presenting you with a chart, and of course, that all-important trading the negative markets that we've seen. That May contract, as Josh was reminding us, going all the way down to $37. Luke Moore, Premium Client Manager, joins us now. Luke, explain more about what we do at IG and the pricing that we provide.
Thanks, Jeremy. I'm just trying to get a quick look. Can you see my screen just here?
We can see your screen. Perfect. And we can hear you loud and clear.
Fantastic. Thank you very much. Well, thanks for having me on. I think I'm going to be coming at this from a slightly different angle to the rest of the guests. So my job is I'm one of the Premium Client Managers here at IG. Some of you may have me as your account manager. If not, I may have met some of you through various different events. And I think one of the questions that we've had most regularly over this period of volatility is actually, how do we trade this? And specifically looking at IG's daily funded bet and our spot prices. And I think there's been a bit of confusion as to how that's happened, how we make that price, and a bit more of a confusion about how we then charge interest, or what we're now calling a basis point adjustment of an evening, to offset some of the move. So I wanted to just explain that because we've explained a lot of it over the phone. I think this is a great forum to have a bit more of a discussion about it. So in the futures space, or probably I should say in the commodity space, everything trades as a futures contract. There is no real spot. Most spot is referenced against is simply just the front month. So with that, there are a number of contracts. There is the front month, which if you're looking at WTI, obviously previously that was May, that is now June. And then therefore you look at the next contract, which is July, August, September, so on and so forth. Now, what we're doing is we are putting two of those contracts back to back. So we're looking at the price of June and the price of July at the moment. And what we're saying is throughout a 24-hour period, what pull on the price, or what is the difference between the price of contract A, which is the front month, and then contract B, which is the next month. So for example, recently where we've had a lot of the contango coming in, that is where the current price or the front month is a lot lower than the future price. A lot of that is to do with the cost of carry, i.e. if I have a barrel of oil today, what is the difference between that and a barrel of oil in a month's time? There is no real difference, it's still a barrel of oil. But what I don't have to do is I can take delivery today and I don't have to pay for it to be stored for a month. So a lot of the talk about the oversupply, the lack of storage that Malky touched on and Josh touched on, is all to do with this contango and this cost that gets baked in. So what we're finding that has happened is you go across a 24-hour period, our price, which is leaning more on the next contract, is actually becoming more expensive as you go through the day. Now, when the contango, or when the difference between the two futures contracts is relatively light, this isn't felt so much, but where it is now, where there's quite an expensive difference between the two contracts, it shows quite a lot. So what I just wanted to show you on this next slide is the prices that we can see on our platform. Now, I took these this morning. What we have at the top is if I just get a pointer, actually, that might be a little bit clearer. So what we have up here is our WTI from this morning. That is the price of our daily funded bet. And you'll notice it's around 25.40, and I could have changed it, was this morning. What you'll see is the June price is actually trading around 24.70, and the July is trading around 25.60. So we're at 25.40. The vast majority of our daily funded bet price is now leaning on the July contract, and that's not overly surprising. The expiry of the June is on the 18th. The expiry of the June is to be on the 18th of May, and the expiry of July is on the 19th of May. So we're in a sliding scale, leaning a lot more on the July price. So what we would expect on the day that the June contract expires, we're then using 0% of our weighting on that, and a lot of it is being weighted upon the July, and so on and so forth, and we roll on throughout. Now, what happens to your position overnight is if you're holding a position through 10 p.m., if I take it back slightly and explain, obviously our prices are now being kind of pulled through a 24-hour period. We're leaning more on July, which is more expensive. Therefore, if you were flat, there was no performance in the oil price throughout the period of 24 hours, you would expect that the daily funded bet would be a couple of points higher. Now, this was very evident that when the contango was probably at its strongest 2 or 3 weeks ago, that basis point adjustment was around 20 points. So you would see that if nothing happened across the 24-hour period, the June would stay where it is, the July would stay where it is, IG's daily funded bet would be about 20 points or so higher. Now, this would affect you quite significantly. So this is where the futures contracts sit right now. So this is contract number 1. This is the front month. This is the June. This is the July. You see that the August is quite significantly more expensive than the June. Now, that's the curve structure. You can see that this contango calms down slightly as we head into next year. But what was interesting is how this has changed over the past couple of months. So we can see the orange line there is the current futures curve. That is the way that WTI is focused and trades as a curve just now. The green line is where we were when May was the front month. And you can see this green dot just here. This is the May contract. Now, the difference between June and July, we see it now, is nowhere near as steep as the difference between May and June. So this was where we were seeing the basis point adjustment much more akin to 20 points. This is where we're seeing it now much more akin to 5 points. Now, what does that mean for your trade? If you're long, you're going to be losing out as a result of that pull on our price. So you're going to be showing that, sorry, in fact, just got that the wrong way around. If you are long, you are going to be benefiting from that pull on your price. So as we go across that 24-hour period, if everything stayed still, you would be making 20 points in the previous green example on that throughout the day. At the moment, this is more akin to 4 points. Likewise, if you were short, you would see your short position lose out as a result of that natural pull on our price. So what we do is we go in to offset that. So what you will see of an overnight, the overnight interest, you'll see a position come across that is to make you good on that overnight adjustment. In fact, surely what I should just say is this is looking at the curve 6 months previous. I had a couple of conversations with clients where previously, if you were long, you were actually receiving funding overnight, and if you were short, you're having to pay. We can see the term structure of the futures contracts was slightly different. This is backwardation. This is the contango that we find ourselves in. So we look at, if we go back to the diagram that IG helpfully put together of how we price things, the overnight position that you see and the choice that you have to make is either I trade one of the futures contracts, which at the moment is trading with a 6-point spread, or do I trade the spot price? So the spot price is trading with the 2.8 spread. That is much cheaper for you to trade from a day trading perspective. But what you get with a futures contract is a fixed expiry and therefore no additional funding of an evening. With the spot, if you hold it through 10 p.m., you're therefore going to be seeing this basis point adjustment that goes through to offset anything you would have seen naturally throughout the day. So at the moment, these are last night's rates. If you are short of US crude, you're receiving 3.93 times your bet size. If you were long, you'd be paying 4.29. Likewise, Brent is slightly shallower, 3.2 and 3.62. So what you have to make a decision as a trader is, do I trade the spot or do I trade the futures contract? What I will just touch on, which I've been checking the questions that have been coming in from the audience, which is great. Thank you for those. Is negative prices. A lot of brokers that are out there at the moment are saying that they are not going to price. A lot of guys are saying that they're actually not making you a price on the front month, just in case the negative prices come through again. That hopefully the guys will have explained exactly why they think that may or may not happen, and will continue to do so in the panel. We have upgraded our systems. We've been working to make sure that if our prices are to fall negative, we are robust enough to continue to price. Our charts will continue to work. We have every hope that we will continue to be able to keep letting you trade and take opening new positions. There's a very small chance that the futures market itself will have similar liquidity issues, and there may be issues at an exchange. So there's a very small chance that we'll be set to closings only. We hope that that doesn't happen. You won't, however, be able to trade with negative stops or limits on the position. It'll only be a deal at market instruction. We simply cannot figure out a way at the moment to make sure that you have negative stops or limits. The only way that the only platform that we're not going to be able to offer that on is MetaTrader. So MetaTrader is the third-party piece of software that we run and offer to our clients. MetaQuotes have made it pretty obvious that they're not going to rebuild the system in order to offer negative prices. So that's unfortunately, we will have to suspend dealing on that. But likewise, you can just move your flow onto the IG account directly. One thing that we have had to change, though, that that isn't just simply the price, is the way that we charge margin. Normally, we charge 5%, be it that's whether you're pro or retail at the moment. 5% of your notional value, therefore, roughly where you can stand and where you're making that calculation. We're changing that slightly. So if we go to negative, it's very difficult that we'll be able to maintain that the percentage basis, because if we went to negative, we would therefore be paying you margin, which is something that we won't be able to do. So we changed that. We're going to margin you at the higher of either 5% of your notional value or 80 points times your trade size, be that in number of contracts times by the contract size if it's a CFD, or whether that is a pounds per point trade size. The break even on that is roughly $17. So if we're lower than $17, our price is going to be more on the, our margin will be working on the 80 points metrics. If we're above $17, it'll be on the 5% metrics. The only change that we're making on that, because of the risk associated with the front month at the moment, we are charging 400 points times by your trade size for the front month future. So that's the only change. I think I just wanted to make the point to you here in this forum that we are very much working towards having a market that gives you the opportunity to trade, gives you the opportunity to continue to make money and make the best of your opportunities. And we are hopefully going to be and continue to be that partner that you choose to trade with for these exact reasons. And that is the end of my slides, Jerry. It was just a very quick one from me. I know you guys have a lot of questions that we're going to put to the panel just now. So I am
absolutely. Yes, indeed.
Luke, Jerry.
Yeah, thank you very much indeed. And in fact, Luke, I'm just going to run a poll. I want to, maybe you could set up all of the webcams for our groups while I just run this poll very quickly before we do get to our next stage of this. I appreciate we're running through time. We do have some questions from the floor, but what I want to ask is now, this poll is now in progress. Is OPEC finished. Now, I've purposely not included OPEC plus, non-OPEC, whatever it is, just OPEC as it is. 60 years old this year, but is it really finished? That's the question. Just wanted to get your thoughts on that from the floor if we can, before we go back to our team, just to give us a little bit more sort of depth on your thoughts on this. In the context of the question we've been asking tonight, oil, has the market changed forever? And I suspect the answer to that is partly in OPEC, or the reaction to that perhaps maybe is the whether or not OPEC is finished. Right, let me just a couple more seconds on that. If you've got any more votes to come in, if anybody wants to quickly vote on that. Okay, I'm going to close it now, just to, that's a fair number of people. So we have got this result. It is, I think, can you see that? I think you can. 18% said yes, 82% said no. Well, I'm heartened by that, because I don't want to see things change that drastically. And for what it's worth, I sort of agree with this. But let's bring our panel in and kick us off very quickly on this subject, because as I say, I think perhaps maybe it does combine with the question that we've been putting tonight about oil, has the market changed forever? Malky, you were first up on presentations. Let me just quickly bring you in and ask you that question. I mean, it was 18% said yes, OPEC is finished, 82% said no. Your thoughts on the question and the answer?
Well, as you know, I to a certain extent tried to squeeze you earlier on to saying, you know, is OPEC plus or OPEC with Russia? But fair enough to answer the straightforward question. I would say that I agree with the 82%. After all, you know, money speaks volumes, and in the end, we normally know, apart from the odd time, as happened in February and March, that the OPEC constituents realise upon which side their bread is buttered. I do think that we are going to have to make sure that people realise that OPEC is really OPEC plus and Russia now, because as soon as you start seeing Russia going off in their own on their own direction, but as Roy said earlier, you know, it's these things just happen, and you know, you only have to spend a little time in the Middle East to find out, you know, how difficult it can be. But your price of $80 for break even, so whoever said the IMF said $80 break even for, I think it was Roy actually said that, and
it was
important.
Yeah. Okay, Roy, I want to come to you on that point, but very, very briefly, are you with the 82% or 18%? You happy that OPEC's got a future?
I think it has a future in a different, possibly very different form. I mean, even before Russia, you had Russia, but with Russia, you think about it, it's an eclectic collection of countries and sovereign agendas and objectives and religions and languages and cultures. So I think I mean, I don't know what it learns from this or what it learned from the 2015 pressure it put on US shale, but I think it must change to survive and exercise the power it wants to. As we've said, you know, nearly all OPEC, well, all OPEC countries are below. They can't manage their fiscal budget, so they're. Yeah,
this is the point that Malky was just referring to. I think this was mentioned actually before we went live to air. You were saying, Roy, that what you were talking about, $80 a barrel, which was the break.
Yeah, the IMF has just confirmed that Saudi's fiscal break even is $80 a barrel. So that means, you know, that the House of Saud, which controls that country, and it does that through the handing out of money, let's face it, is way short of its fiscal budget. So, you know, it's an A-rated lender, right? So it can lend money, it can issue bonds. Saudi Aramco just reported a 25% drop in quarterly profits, yet, as Malky said, held on to its dividend. Can't do that forever, right? So there is intense pressure to put bread on the table, metaphorically, in these countries. And if Saudi is in trouble, the rest are in a lot of trouble. So my direct answer to your question is, surely it must change, especially with the addition of Russia, You think of how eclectic a collection of countries it is now with Russia.
Russia, I think, came out and said, didn't it, that it was okay with these sort of prices for 6 years. I mean, that was bravado. We can't seriously think that Russia's going to be okay for that amount of time. But Russia, similarly, like all the other nations, of course, it's losing money at these levels. Yeah. Okay. Look, let me just quickly run through some questions. I'm very painfully aware that the fact we got a little or no time left, unfortunately. But can I just quickly put this from Anthony Penn? Will we see a drop in the price up to and into the next expiry on the 20th of this month? Talking about the futures markets. Josh mentioned this briefly. Malky, are you satisfied that we're not going to see negative pricing again in futures contracts coming up, or what are your thoughts on some of the charts that Josh was putting out there?
Yeah, I mean, I said that I thought it was almost impossible. Nothing is impossible. And I thought his points were very clear. And of course, as you run towards it, the nerves that get into any market that plays with the physical is important. But if you see what the ETFs did in terms of, middle of last week, they were cleared off all their short-term positions. So I don't think we're in a situation where we could make that mistake again now. Could be proven wrong, but I don't think we will. Yeah.
Josh, I want to bring you in on this and actually talk a little bit more about where we go from here in terms of pricing. I noticed on your chart, I think it was WTI, there was a gap, I think, opened up on the daily chart around about March or so forth. What are the resistance points on the way up, assuming that we are pretty much on the whole the rest of this year going on the upside? In terms of some of the points to watch out for on the way up that could form resistance, you were talking about that Fibonacci level that we just hit at the moment, but if we escape the bounds of that, is it going to be easy plain sailing up on the upside to $50 a barrel, which I know is what we've been talking about earlier on as a possible endpoint for the year? Josh, I don't think we've not got your microphone up. I think we are short on a microphone.
Can you hear me now?
Yes, I can. Yeah, thanks. Josh, over to you.
I guess that's a big question, whether we're going to get up to 50 by end of year. I think, we do have some key hurdles. Like I said, for the short term, what we're looking at in WTI is going to be whether we break through 23.84 to the downside, 27.39 to the upside. Until that happens, look, we've been trading within that range over the last week. And certainly as we move closer to the end of the contract, I think that's going to be the really interesting thing. Which direction do we break? And that really is going to tell us a lot in terms of market sentiment. In terms of the major resistance level to really break out of the downtrend that we've been seeing through 2020 thus far, it's 31.57 on that DFB for US crude. That's really the line in the sand. If we break out of that level, then I think that's going to really embolden certainly technically minded traders that the worst is over and that they can feel a little bit more bullish for this market. It's difficult, quite frankly, in terms of how to play these markets. Like I said, people want to try and take advantage of the idea that we've bottomed out and by historical standards things are very cheap. There's different ways that you can do it. Like I said, there are faults with buying into maybe an ETF like USO. One way that potentially people can do it is to be able to essentially buy into a contract that is longer dated. Of course, if you're trading with the DFB, then you have overnight charges, but you're going to have a smaller spread when you enter it in the first place. If you take a contract, then you're not going to have those overnight charges, but you're going to have a little bit more of a wider spread. Yeah. Of course, if you have a later contract that you're buying into, it does give you a longer period of time. But of course, I mean, look, it depends on how much you're actually willing to lose if things go against you. But certainly, it's one way to potentially look at it.
Yeah. Pick up another question. Can any of the panel talk about their views on the impact to oil companies, e.g. BP? Malky, this I think goes back to something that you mentioned, the fact that companies are deciding to cut back on capex. Now, when we saw oil prices down, not at these levels obviously, but somewhere not too far away from these, the last time we saw oil prices low down, we heard a lot about these companies doing the same they're doing now and stopping their capital expenditure. Now, this has a knock-on effect, doesn't it, for future supply. And of course, that's all got to be counted in when you're looking at oil prices in the next few years. What does an oil price like this do to BP and their operations? I mean, how much behind the curve will they get in future years, not being able to supply the increased demand that we expect to be coming through in the future years because they haven't put the capex in now?
Well, there are two questions there. The first bit is that all the companies did exactly the same as they did the last time, and they cut 20, 25, 30% off capex. And I remember at the time, 2016, doing the number, and those numbers add up a lot. And I started with 100 million, then Woodmac got to 250, and in the end, we got to $1 billion. But easy enough to say, right, we're going to have a lot of numbers off. Now that will come off the market in 3 years' time. So you'll find out that in 2023 or 2024, investment that had been going into the Gulf of Mexico, it'll vary. Some of it's shorter term than others, particularly in the US onshore. But so the first thing is that accumulation of capex cuts now will come home to roost and push the oil price up in the longer term. And the second thing is completely differently, is that in previous oil price falls, most majors have an upstream side, which is the exploration, and a downstream side, which is refining it. Simple enough, everyone knows that. But they don't normally get a situation where the oil is cheap and they're digging it out of the ground and then they can't sell it to anyone. So, it's all very well in the States. And as I said, it was £1 a litre here. It was, it's 80 cents a gallon off in the States, but no one's driving anywhere. So in fact, they're not only not making any money upstream, but for the one time normally, they're not making any money downstream either.
Roy, you're an upstream specialist, I know, aren't you, in various past lives you've had in your 30-odd years in the business as a petroleum engineer. In terms of the destruction, in terms of the pipeline I mean that in the broadest sense of the term, for companies investing in future production, have you seen the situation like it is at the moment before in this business, in the potential for cancellation of exploration because of the price of oil at the moment and companies just pulling away? Is this worse than you've ever seen it before, or is this just not as bad as it has been previously?
It feels worse in terms of the overlay of the seismic shock to global economies and the effect on GDPs I mentioned. And we take that two ways. So, developing Malky's answer, basically we stop exploring. So you'll now see drilling rigs stacked in the usual parts of the world. The road that goes from Odessa to Midland, the Cromarty Firth, you'll see old ones scrapped. So we stop exploring. And the two companies I'm in, we concentrate on maintaining production, because that's, cash being the lifeblood, as I said before. And so we leave oil in the ground because we don't explore and appraise. So the service sector gets really hard, as it did in 2015, and hasn't really recovered. So the rig count it's been at near all-time lows. Actually, it was just creeping up because we saw $60, $70 in December, and of course we've now fallen way off that. So yeah, we leave oil in the ground. We just stop exploring. So reserves replacement ratios go down. What hasn't been mentioned is, the reserves test on reserves-based lending type covenants. It's a complete shock, but no, this is a huge seismic shock to the global economy, which is the engine for the oil and gas that we explore for and produce. So that, and as I said, I can't see that engine recovering to, pre-COVID levels for possibly a year, possibly longer, because the recovery is slower than the fall. By necessity in some way.
Yeah. Okay. Let me just. There was a question here about L oil, and I can't now see it. I was going to ask about that. Let me just quickly follow up, if I can, with another question. Why does the USA government not add to its strategic stockpile when the price goes negative? The US, I believe, is pretty much at capacity, isn't it, for stockpiling, isn't it, Malky?
Well, there's 75 million barrels left to go in the SPR, and to be honest, they had it all stacked up, ready to do it, and it failed one of the votes in the Senate, I think it was. But then Trump, you may have seen it actually, because on the day that it went to negative, he said he'd buy all the oil in the world at -$40. Well, who wouldn't? But no, they want to buy a bit more. As I say, at the moment, without they could expand the cabins, of course, but they've got about 70 million, so they will. I understand they have been either buying or looking to buy. I think there's one or two bits of lines of things need to be done, but also India and China can top up on their SPRs as well. And I wouldn't have been at all surprised if the Chinese hadn't been buying it in the last few weeks.
Yeah, okay. Just staying with you, Malky, because I think this is a question as well for you. What are your thoughts on L oil and its potential chance to drop into a zero value? And I think there's another question. If you could also ask, can they see L oil returning to around $40 to $50 range again too? What are your thoughts on this?
Sorry, what's the stock?
This is L oil ETP price. Yep.
Yeah, it's probably a Josh question, isn't it?
Okay, Josh, you able to come in on this? No, perhaps probably not. We'll get clarification on this. I'm a little bit unsure myself as to that. I'll see if we can get clarification. The other thing I did want to ask you, Roy, very quickly, was this difference between oil and gas. Oil and gas. We saw a picture of Greta Thunberg on your presentation, and clearly there's a lot of environmental pressure to adopt gas over oil. I mean, you're a company which produces gas in Cameroon, and I think your gas is produced to produce energy, isn't it? So it goes straight into the electric grid. Is that right? I think.
Actually, it goes into it brews beer. It converts vegetable oil into soap.
Right.
We have 43 customers, currently about 30 online at one time, and a variety of it. The big off taker is gas to power, and the smaller industrial customers are a whole variety of light and medium industries. Was there a further question on?
Well, it was just really, I mean, why gas over oil? I mean, you run a company which is predominantly gas. You also have oil interests, and of course, you're also the non-exec director for Hurricane Energy. Do you see the future as oil, or do you as gas, or do you think that that oil's still got legs in the long term?
I mean, there's a lot of oil and gas still to be discovered and discovery still to be developed. In terms of your question, personally, I don't have a preference because I also have a stranded oil asset in Siberia where the valuation has just plummeted. Obviously, if you are in a carbon reduction, if your aspirations to reduce carbon, then you can burn. You know, the heavy fuel oil we displaced in West Africa, for example, we've reduced the carbon footprint of those businesses by 70%. And there is I mean, Africa, a specific answer to Africa, there's an awful lot of stranded gas in Africa, with Angola venting and flaring all of it. Nigeria rumored to have 100 trillion cubic feet of reserves remaining, even though they've been flaring gas since day one. So there's a lot of it. It depends on your speed of carbon reduction in your sort of personal and corporate aspirations, I would say, and where you are geographically.
Right. Okay. Shall we quickly return to the L oil question, Josh? I just want to ask you if you can get this chart up. It's an ETF ×2 leveraged oil product. L oil ETP. I'd be interested to see if you can get a chart up on that. Let me just quickly run another question past you, and this is about what's happening in the long term for OPEC. Do you see OPEC staying as it is, or is it going to have to open its doors for more members? I think we touched on this, didn't we, with this Russia question. There are, I know Russia's presumably resistant to joining OPEC, but we've got some other really big producers as well, Mexico, Norway, and so forth, that aren't part of OPEC. Do you see the future of OPEC only if we get an expanded membership base? Malky?
No, I don't think they need to expand it, but they need to have all these people, on the speed dial, so to speak. I think that as you say, you may never have Russia joining it. Actually, one or two people have left OPEC in recent years, but partly because they don't add up to the amount of oil that makes it worth the while, and so on. So I wouldn't say it was necessarily going to change, but the bottom line is that whether you're in OPEC or not, if you're a producer, you are going to have to pull together mighty hard over the next year or two to keep the market tight.
Yeah. Okay. Josh, very quickly, have you found the chart? Are you able to talk about L oil as a leveraged ETF product? It looks like not. I think we might have to.
I can hear you. I mean, look, I don't know if this is necessarily the one that you're looking for, which is the 3 times short ETP. Is that what you're talking about?
This is actually 2 times leveraged, actually.
2 times. Okay.
ETP.
Yeah, I mean, look, I guess we're talking about whether things can get to zero. That's the difference that we're, if you're talking about a stock going to zero, you're talking about the stock not necessarily existing anymore. When you're talking about these leveraged ETFs or ETPs and the like, then of course it is very possible, because if you see substantial upside and you're trading at multiples of the actual movement on the day, then you're of course opening yourself up to risk that you could see a move back down to zero. So if you're 2 times or 3 times short on the market and we see substantial rallies and we think the market probably has bottomed out, then you're taking significant risks in terms of looking for that. But that's the innate risk that comes with multiple shorts or longs when you're looking in the ETF environment, which by and large people usually think of ETFs as being a little bit safer and a way to diversify their portfolio. This is pretty much the complete opposite of that.
Yeah, finally, Josh, while you're there, very quickly, just answer the question that we had at the very top. Oil, has the market changed forever, or are you happy that it's going to return to how it was however long ago?
Yeah, I think this kind of reminds me of the crisis we had in the Eurozone back in the early 2000s. I remember going to an event in Bloomberg and everyone said, if we come here in a year's time, how many countries will be in the Eurozone? And everyone was saying there was going to be a huge amount of countries that would have left. Maybe the Eurozone wouldn't exist. And one person said, nothing's going to have changed. And I think it's always common nature to think that, when you're at the height of a crisis, that everything's, this is just the beginning and everything's going to be completely different and it won't function as it currently is. Ultimately, this is likely to be maybe not short term, but medium term environment that is going to play out over 2020, and then things will likely stabilize over time. So, I think at the moment they're having to try and pull some strings to be able to get things in line and, get other countries on board. But once things normalize, I don't necessarily think that OPEC's completely kaput.
Yeah, oil, Roy, has the market changed forever? Or are you happy that having just taken the reins of a small cap company, that things will return to normal?
Well, as I said, I mean, it's a huge bump in the road, but I think it always has been on in a constant state of flux, reacting and adapting to macro things. But this is just a huge bump in the road, and it will return to whatever your version of normality is. But I think that's quite a long time.
Yeah, Malcolm, you spoke about a number of crashes you've seen over your years in the business. Are we going to return to some sort of sense of normality? Do you think that the market has changed forever, or is it back to normal in some time in the not too distant future?
Well, when all this happened in February, I went, oh, not again. But the funny thing is, I've been in the industry for 41 years. So I started in